Hello, good afternoon. Welcome to our webinar this afternoon, and thank you for joining us. We are here in Oxford at the SAI Business School, University of Oxford. I know we have people signed in from a range of different countries today, so thank you for taking the time to sign in, whether that's in the morning or later in the evening, wherever you are. So today we will have a webinar focusing on real estate, and in particular looking at the opportunities and threats and challenges of the current low interest rate and the effects that will have on the market. This webinar is in support of our activities in real estate at the Said Business School, where we teach on our MBA elective. We have a real estate society with a conference coming up in about 6 weeks' time, and we'll share some details of that later on. We also have an executive program which will run in the last week of June, and we will share some more details of that at the end of this webinar as well. Our speaker today is Professor Andrew Baum. We have a brief version of his bio here. So Andrew is pretty uniquely qualified in that he spent the last 30 years with one foot in very much in the real estate industry camp, working with institutional investors and advising on strategies there, setting up and selling on various real estate enterprises, and sitting on the board of several of those at the moment. Excuse me, his other foot is very much in the academic camp, so he leads the real estate activities here at the SAI Business School at Oxford now, previously at Cambridge, and before that at Henley and the University of Reading, where he also studied. His real focus is on all aspects of real estate investment, so looking at cross-border and international investments, innovation, and currently looking at the world of PropTech and the effects that technology is having in the markets. Finally, just to say that as a teacher and an author of materials, Andrew is one of the top-selling authors in the real estate area, with combined sales of over 60,000 copies of his various textbooks. So, Andrew, I'm going to hand over to you to address the ongoing issue that we've had for a while. And I guess the question is, how long may it last in terms of interest rates and how that affects the real estate investment markets. Over to you. Thank you.
Thank you, Steve. Okay, so today we're going to look at the relationship between interest rates and property values, and we're going to look at that on as a global phenomenon. The data you'll see has been analysed from the perspective of the US, the UK, continental European markets, and Australia. The data I'm going to present is all going to be UK, but I think you should see that as representative of a global phenomenon in the developed markets. So the low interest rate phenomenon is affecting property markets and asset allocation decisions globally across the developed markets, and it strikes a little bit of a divide between the developed and the developing markets, which we'll talk about later. We've already got a couple of interesting questions related to that coming in. The relationship between interest rates and property values is intuitively reasonably clear for two reasons. First of all, if bond yields and interest rates are low, then the opportunity cost of not investing in real estate is low, and that will tend to attract more money into the property sector because it will look relatively attractive to low interest rate generating investments elsewhere. So the opportunity cost issue will push more money into the property market. And then secondly, of course, because so much property is financed through borrowing and debt, if interest rates are low, then it's very likely that people will bid more to buy real estate because they can afford to service the debts at low interest rates. So we would expect there to be a negative relationship between bond yields and property prices, so that as risk-free rates continue down as they have globally, as the slide shows, you'd expect that to push property prices up, and to a reasonable extent we have seen that, but the relationship is not quite as simple as you'd expect it to be. What makes this particularly complicated is that there are, of course, in markets there are always going to be different views of the future, and that's what makes a market, and we've been observing these two different pictures of the future for at least at least 10 years now since the global financial crisis. And the situation is that many people have been surprised by how long the low interest rate environment has carried on for. I remember sitting around a table in 2008 hypothesizing what bond yields would be 5 years out, because we were basing our property decisions in 2008 on what we thought the interest rate environment 5 years out would be, and we were horrendously wrong. We thought that bond yields would rise back up to their average level. They didn't. It meant that property values rose more quickly than we expected, and we missed all sorts of opportunities that would have been high return. This picture shows the dotted line is the old view of interest rates recovering back up again. The solid line is the more current view from late last year, and it shows a typical picture of the dotted line moving downwards. In other words, expectations of higher bond yields and interest rates being revised downwards to expectations of not quite such high reversions. So markets are getting used to the idea of lower for longer, and every quarter that goes by, every time we get a new economics report, generally speaking, we've seen interest rate expectations depressed for longer, so that we're looking at interest rate environments which go on for a longer period. Now that's been somewhat challenged by the Brexit vote and by the Trump election, and we'll get onto that later. But generally the environment is one where lower for longer has been the watchword. And yet, if we look at the next slide, economic forecasters still expect a rise back to some sort of level of normality over a 3, 4, 5 year period. And this lower for longer perspective that we saw on the last slide, coupled with this alternative perspective of rising bond yields, is the fundamental problem which is creating confusion in the global property markets. Because investors really don't know where bond yields will be in 5 years' time, where interest rates will be in 5 years' time, and therefore where property values will be in 5 years' time. If you have a perspective that bond yields will rise, then property becomes less attractive. If you think bond yields are going to stay lower for longer, then property looks like a good buy. And that's a real problem. So consensus remains that there's going to be some sort of uplift in bond yields, and that likelihood has probably been increased recently by the political events that we've observed. So you can construct two alternative arguments, and this is one alternative argument here. Real estate looks really, really good value. Office vacancy has fallen across the major markets. There hasn't been a lot of development. Future completions are constrained so that the supply of property isn't huge. Generally speaking, the cap rate or yield on property is higher than the yield that you can get on government bonds or corporate bonds, and therefore you're getting a better return on property just through income, and of course you're getting a better return than the cost of borrowing in most markets, which means that cash on cash yields are very attractive. A cash on cash yield simply means the income that you keep after you've paid your debt. And right now, if you've got a reasonable property yield and you've got very low interest rates, then the cash on cash yield gets boosted, gets enhanced by that gap. And right now, a lot of markets are offering pretty attractive cash on cash yields. Now, if markets are expecting lower bond yields for longer, then real estate looks like an interesting asset. And the little box on the right-hand side of this slide is indicative of the optimism that can spread through these markets. Unibail-Rodamco, admittedly a very, very highly regarded European real estate company, the biggest real estate company listed in Europe, recently, in the last year, launched a 10-year bond which raised 500 million. It was more than 6 times oversubscribed, and it was offering a fixed coupon of 1.375%, a tiny rate of interest being offered, fixed interest, not a convertible, 6 times oversubscribed. How would we explain the attractiveness of that? Only the fact that everything is such low interest rate bearing at the moment that any corporate bond secured by real estate looks very, very attractive. And if we look at these yield gaps, it's very, very attractive, very, very interesting and tempting to look at the simple gap between the yield you can get on property and the yield you can get on a fixed interest bond. And what you want as a property investor is a large positive margin. So you'd like to be able to say that I'm earning a 6% yield on my property when I only get a 1% yield on a government bond, therefore I'm getting a 5% premium. And this slide shows that the average premium has been 0 over the long period in the UK, and the current yield gap is nearly 4. So that would say real estate looks very attractive right now. It's offering me a big yield compared to what I can get elsewhere. Now, in many ways, the more interesting relationship is between property and indexed bonds. The argument here being, if property rents are expected to rise with inflation, then you're buying something which is more like an indexed bond than a fixed interest bond. You're not buying something which is going to give you a flat rent forever. You're getting something which hopefully will provide a growing income. And an indexed gilt yield in the UK will provide that growing income. So here the relationship is equally powerful. The average yield gap between property and indexed bonds in the UK has been just over 4%. So you can think about that 4% as a risk premium for taking on the risks of buying property rather than a government indexed bond, and to some extent the risks that your rent won't keep pace with inflation. Right now though, you're getting more than 7% yield gap. So with index-linked gilt yields showing you nearly minus 2% in the UK, and by nearly I mean 1.8% negative, you're getting a very unattractive yield on index bonds, and property again is looking very attractive because it's giving this huge yield premium. If we go to more specific markets like the City of London office market, you can see the grey shaded piece which sits below the line to begin with and then above the line. It's showing this spread between property yields and government bond yields, and the bar above the line is sitting at a pretty high number compared to the long-term average, which is the middle line there that you can see. So if you wanted to buy an office building in the city, then you're getting a reasonably good premium over bonds. And the next slide will show something very similar against short-term interest rates. And now we're more focused on the cost of borrowing. If you went out to borrow money to buy real estate, then the dark blue line that you can see is the collapse, the absolute collapse in short-term interest rates. It shows the effect of quantitative easing in 2008, where the line suddenly collapsed down to pretty much 0. It stayed there. Notice then the light blue line, which is the property yield for City London offices, and how resistant that line has been to collapsing. And the maintenance of that premium of the light blue line above the dark blue line for the last 5 years shows the reluctance of the market to be sucked into massively high prices for real estate, but a creeping acknowledgement that property is looking good value, hence the continued drift down in that property yield or a drift up in property prices. And against index-linked bonds, again, we're seeing this, if you look specifically at the city office market, again, we're getting this pretty big premium of at least 5% over index bonds, which is another positive indicator. So when we add all those things together, property looks good. And if I was a property bull, then they're the sorts of slides I'd be using to get people to buy property. But at the Oxford Real Estate Conference last year, we had a very, very well-regarded property professional who said that we're absolutely on the edge of a precipice, and I'm selling everything I can, and I'm selling everything I can whether it's good or bad. I'm just getting it out the door. And his logic was based on the following arguments. We're 8 years into a cycle, and the cycle is usually something like 8 years. So we had the last collapse was in 2008. We're pretty much at the point where we'd expect another minor correction at least. Transaction volumes have been really falling. The peak of the UK market was clearly the spring-summer of 2015, and in that year, 2015, we had £70 billion worth of transactions in the commercial property market. That pretty much halved in 2016, and the confidence of investors has collapsed. It's collapsed partly because of Brexit, partly because of the American election, partly because of political uncertainty, but really I think it's because people are just uncertain about where this bond yield environment is going. Investors know that they're dependent on continued low bond yields, and if the bond yield does correct back upwards again, then what you really don't want to do is go into the property market, pay a lot of money for property in historical context, and then find that it's worth less in 5 years' time because bond yields have risen. And investors are very aware of that, and therefore they're to some extent sitting on their hands and watching and waiting. So unfortunately, if you build in this reversion to higher bond yields and you look at a 5-year hold for an office investment in the US, the UK, Australia, Germany, then everything looks overpriced. So there's the bear case that if bond yields go back up again, we're going to be selling our buildings for less than we paid for them now. We don't really want to get caught in that trap. And the next slide will show us this particular conundrum. Here's a forecasting model for markets in the UK. The thing to focus on is the the two right-hand columns. If we think that the bond yield is going to rise over the next 5 years in line with the consensus view, then our model suggests that pretty much all of these markets should be sold. In other words, their prices are going to fall over the next 5 years. If, on the other hand, we think that bond yields are going to stay flat, so we're in a lower for longer environment and bond yields stay where they are, then most of these markets start to become buys or holds. And I think this characterizes the conundrum that real estate investors are facing right now. It's the bond yield forecast which is crucial in deciding whether you should be operating as a buyer in this market or as a seller. And I think that explains why a lot of people are doing neither and they're sitting on their hands. So that's the tour of the market prices and the conundrum facing investors. And given that we're sitting in a university, we really need to get into the theory and understand what the algebra would tell us. So it's one thing to believe that there's a connection between bond yields and property prices because of opportunity cost and because of the costs of borrowing. But there is a more formal way that we can get at this relationship and then begin to form a more educated view about the future. Now, I do apologize for the fact that we're using this algebra, but in plain English, the bold formula that you see in front of you there is saying that the cap rate for property, which is an indicator of the price of property, and just to restate, remember that a low cap rate means high prices. So the price of real estate is a function of the risk-free rate, and that's the bond yield. And in this formula, I've got it as the real risk-free rate, so that's the indexed bond yield, plus inflation, plus a risk premium. So those three first terms, the real risk-free rate, inflation, and the risk premium, that should be the IRR in total that you should need to buy some real estate. So if index bond yields were at 0 and inflation was expected to be 2 and you wanted a 3% risk premium, then you'd need a 5% IRR to buy some real estate. However, the cap rate is not the IRR, and the cap rate is different from the IRR because of the expected income growth that you can get from the investment. And that's going to come from three things. So you might enjoy real rental growth in a market that's got growing demand and limited supply. You might see that rents rise in real terms. You might also benefit from inflation, so we'd expect that inflation would push rents up. And those two things will be they will encourage higher prices to be paid, so they would reduce the cap rate. And then finally, if you think your building is going to depreciate, it's going to wear out over time, then you'd need a higher yield to compensate for that. So the net result of those three right-hand terms, real growth, inflation, and depreciation, will usually be to pull down the property yield in line with expected rental growth expectations. Notice also that inflation expectations, in theory, won't affect property prices because the inflation appears twice in this formula, once as a positive, once as a negative, and therefore wipes itself out. And that is true in theory as long as real estate rents are inflation linked, which is an open question for some markets.
Okay, thank you. So we just a quick pause to say that if people have questions as we go along, then please do feel free to enter those in the question box, which should be on the screen in front of you.
Okay, so I think we can get to the complicated algebra is quite daunting, but I think we can get to a simple way of thinking about this by looking at three scenarios. And the three scenarios come from a fundamental understanding of what drives a bond yield. If we focus on fixed interest government bonds, then the components of those fixed interest government bonds are threefold. First of all, the real risk-free rate, the indexed bond yield in the UK, which currently is about minus 1.8, is the real bogey, the real benchmark for yields across the market. The fact that we've got a negative real yield across the world is unusual. It's not unknown, but it's unusual. Secondly, expected inflation is going to drive bond yields upwards. And the higher the rate of inflation you'd expect in an economy, then the higher the bond yield that you would expect to be paid out, because there's no point in investing money for 5 years and then be given something back that will not buy anything. So you need to be compensated for inflation. The real risk-free rate, by the way, is your compensation for losing the use of money, and that would normally be a positive number. If somebody's going to take money away from you, you'd expect to be given money in exchange for that. Right now, people are paying to have money taken away from them, which is a very curious phenomenon. Mm-hmm. Thirdly, because nobody knows what inflation will be, if you are buying a fixed interest bond, then you're at risk of getting your inflation expectations wrong. So if you bought a fixed interest bond, say a 5-year fixed interest bond, and you were offered, let's say, a 2% return on that, which is a slight negative real risk-free rate plus, let's say, 3% for inflation, but then inflation turned out to be 10%, then you're going to get back much less in real terms than you put in. So you need to be compensated for that risk that you're taking. So usually there's a risk premium, an inflation risk premium, or in corporate bonds a default risk premium, which would have applied to that Unibuy bond that we saw previously. So they're the three component drivers of bond yields, and right now in the UK we're looking at bond yields of about 2%. In Australia we're looking at about 2.5 to 3. In the US we're looking at 2, and they're the three drivers, and they're all starting from a slightly negative real risk-free rate, inflation of somewhere between 1.5% and 3%, and a small inflation risk premium, which get us to the 2-3% bond yields that we're used to. Now, I think there are three scenarios that we should look at that will drive property prices in the future. One scenario is that we end up with lower for much longer. So the lower for longer environment continues. We end up with low interest rates, low bond yields for a very, very long time. So the decision we took in 2008 that bond yields were going to revise upwards and made us led us to make bad decisions. Let's say that we would continue to be wrong for a very long time, so bond yield will stay low for a long time. That's one scenario. Second scenario is that the real yield rises. This unusual phenomenon of negative real yields goes away. We revert back to a more normal world where we expect to be paid for giving our money away. And then thirdly, given that inflation is such a driver of bond yields, what happens if inflation expectations rise? If we end up with a surge in inflation which is driven by quantitative easing, more velocity of circulation of money, or even helicopter money, where we're all given money to spend just to create some inflation, what would happen in that environment? I think the first thing to note is that the low bond yield environment is not something which is as unusual as a lot of us expect. And those of us who are getting on in years and were educated in the 1970s and to some extent the 1980s, we got the idea that bond yields could be very high. They could be 10%. Inflation could be 12%. We've seen returns on government bonds of between 10 and 15% in the 1970s. And we've seen our mortgage interest rates be as high as 10 to 15%. And so we've got it burned into our brains that there is this risk or even probability or even certainty that bond yields will revert back to a big number. But if you look at the long-term history of US Treasury bill rates going all the way back to 1870, then actually interest rates were unusually high in the 70s. And this idea that there's going to be some reversion to big numbers is probably misguided. So it may just be that lower for longer is what we're going to get, because that's what we've always had in the long run. And the 70s is the aberration, not the 2000s period. We also need to look at the correlations. You know, what is the most important relationship? Is it between fixed interest bonds and property yields? Well, here's a 15% correlation between the green bar, which is the property yield, for offices in the UK, and the red bar, or the red line, which is the fixed interest bond yield. It's by no means a strong correlation. 15% suggests some correlation, but you can see that at some points in that relationship they were going in opposite directions and at some point in the same direction. So we can't say that there's baldly a very strong relationship between property yields and fixed interest bond yields. But look at the next slide, which is much more revealing. Actually, not this one, I do apologise. Can you go on, Steve, to the next one? Here's the money slide. This is the real money slide. The relationship between fixed interest bond yields is not as strong as the relationship between indexed bond yields. So this slide is suggesting that the markets believe that property is an inflation hedge. If you can buy an index bond yield, which gives you inflation linking, or you can buy property, this slide shows a fantastic correlation, 73%, so that every time the bond yield moves down, the property yield moves down with it. So markets appear to think that property is an inflation hedge. Therefore, they're focused on the yield gap between property yields and index bond yields, which has averaged something like 4%. So you can see over that period that the average gap between the green and the red is about 4%. And now it's standing at over 7, as we've said before. So this slide is suggesting that we should be very confident about property returns given this yield gap. Now, it does rely on there being a connection between property rents and inflation, which is the previous slide. So if we can go back to the last slide, Steve. This is now the big question. Is there a strong relationship between rents and inflation? Because if there is, then that relationship between index bond yields and property yields is the really important one, which the markets appear to believe. Now, as usual, there are two ways of thinking about this graph. First of all, if you look at those two lines, there isn't a strong correlation between the two. So unfortunately, I can't tell you that there is a very strong correlation between inflation and rents on a year-by-year basis. You can see that in some years we get massive rent rises way above inflation. In some years we get rent collapses way below inflation, and there's not a strong correlation between the two lines. But if you look at the box, over the long run, inflation in the UK has averaged just over 3.2%. Rental growth over the same period, which is 35 to 40 years, is just below 3.2%. Now you can regard that as a meaningless accident, or you can take it as reassurance that there is some connection between these two numbers. And my suggestion is that you should believe that in the long run there is some sort of interconnection between inflation rates and property rents, and they are technically connected. So statistically these are connected, although they're not correlated in the short term. So we go two past. So going back to our three scenarios then, let's say that we can buy a city office building on a 4% yield, which means that we pay 25 times rent to buy the building. And the current 10-year gilt is 1.5 in the UK, and the current indexed gilt is about minus 1.8. What happens if, number one, bond yields stay low, number two, real yields rise, the indexed gilt yield rises, and number three, inflation expectations surge as they might do? If bond yields stay low then, plugging numbers into our equation, the nominal risk-free rate is about 1.5. If it stays there, a risk premium of 3% above the bond yield, which is something like a long-term accepted average for real estate investors, growth in line with inflation and a reasonable allowance for depreciation tells us that a 4% yield is about right. So if bond yields stay low, current property yields are sustainable, prices are fair, and that works in a real analysis as well. I mean, we are making some reasonably heroic assumptions about these numbers, but it suggests that at a first sight, property yields are sustainable, prices are fair if bond yields stay low. However, if real yields go up, so now we're looking at rises in index-linked gilt yields from minus 1.8 to, let's say, a half, then the property yield is no longer sustainable at 4%. It would have to rise to 4.5. So we're now saying that property prices would fall. So if real yields rise by, let's say, more than 100 basis points, then we're starting to move into a market where we would expect property prices to be challenged. So we've got about a 1% wiggle room before that happens. And then the final scenario, if inflation expectations surge, plugging our numbers into the same equation, well, as we've said before, because inflation doesn't affect property yields in theory, because we've got inflation driving up bond yields and at the same time driving down cap rates because of rental growth, then the effect is neutral. And if inflation surges, even if it doubles, then you shouldn't expect any particular impact on property prices. In fact, we could see a situation where values rise, but that's based on this presumption that rents are an inflation hedge. And if you remember the red and green bars, it's not obvious that they're an inflation hedge in the short term. In the long run, it looks reassuring, but in the short term, you could easily get hurt. So if we summarize our three scenarios, we've got scenario number one: bond yields stay low, and this is likely to be the situation if we continue to see a lot of money saved, lots of liquidity in the system, forcing down the reward for savings. Then it looks like we would have sustainable property yields. In other words, the lower for longer argument means that property prices are where they should be, and people should be quite confident about buying real estate. If real yields rise, if index-linked bond yields come back up from the current minus 1.8 in the UK or the slightly negative numbers in Australia and the US, then we would expect property yields to rise and values to fall. If real yields rise by, let's say, more than 1%, you've got a bit of a cushion before that happens, but property yields would start to rise and values fall if we had a significant correction in the real yield. And then finally, if inflation expectations surge, then the issue is absolutely to do with the leases that you have in place. If you can collect inflation through your lease rent, because you, for example, have an indexed lease in continental Europe, then you're looking good. If you have fixed rents and you can't collect that inflation, which is generally the case in the UK, then it's not so good. The irony of the current situation is that we're getting more inflation surge in the UK than we are in continental Europe. So in the market where you need connection with inflation through your rents, you're not getting it. And in the markets where there is no inflation, you are getting it. So it's a slightly frustrating situation. So to conclude on those scenarios, what's going on right now is that bond yields have actually corrected upwards since last September. The Trump election appears to be the stimulus which has driven bond yields up. The question then occurs, why have bond yields gone up? Have they gone up because real yields have gone up, or have they gone up because inflation expectations have surged? And there's a very simple answer to that. Bond yields have gone up because inflation expectations have risen. Real yields are still negative. It's all about inflation, and so property looks good if you can collect inflation through your rent roll, and everything should be focused on that right now. The risks in the market are all to do with your rent line and whether you can collect inflation-driven rental growth. That would be about it, Steve.
Thank you very much, Andrew. That's fantastic. It's a really good summary of where we are. I'll let you take a quick drink for a moment. We do have some questions that have come in, so we'll have a look at those in a moment. Just say that if you do have questions there as well, you haven't asked those yet, then the way to do that is to use the question panel on the webinar software in front of you. If you can get to Oxford in the UK on the 1st of March, you can also ask questions in purpose. We'll have our Oxford Real Estate Society conference there on the 1st of March. The link for that is in front of you. That will show you the programme. Most of the speakers are confirmed now, and registration is also open, so please have a look at that. But to go on to some of the questions, the first question we have had in is looking at emerging markets and Africa in particular. So how do you think that today's low interest rates influence investor sentiment in frontier markets in Africa, or are there other factors to consider? If so, what are they?
There are some very, very interesting questions. There are lots of things to consider, that's for sure. But I suppose the simple starting point is that is that markets, emerging markets, look more attractive now in the context of these low bond yields and these low property yields. There clearly is a split between the highly developed markets with very, very low interest rates and low bond yields and the emerging or developing markets where there are still high yields on offer. So that even in markets like Bucharest, Romania, you might be able to buy an office building on an 8% cap rate where you'd be paying 4% in Frankfurt. So you're paying half the price effectively. In Africa, the issues are more complex. The yields on offer are high, and that is very, very attractive. The problem for Africa is to do with currencies as much as anything. There is a pretty strong theory about the relationship between interest rates and currency movements, which doesn't always work in practice, but most investors are aware of this, even simply because it may affect the cost of hedging the currency. But if we're in a high interest rate environment, let's say South Africa with interest rates of 10%, then one would expect the currency to depreciate in the long run against a lower interest rate currency. So it may look attractive to buy high yields in emerging markets, but if the currency movement is looking negative, then it sort of it does somewhat depress interest. However, I wouldn't wish to be negative. I think there is going to be a lot more interest in emerging markets in places, particularly like Africa. And the challenge for Africa is to create deep, liquid property markets in more than one country, so that international investors can start to allocate money to the region as a whole, knowing that there are going to be several markets that they can play in where there is some certainty of stability in the currency. And I know there are lots of very, very intelligent, hard-working people creating these markets right now, and some of them are our graduates, and I'm very proud of the work they're doing. So I think there will be a lot more opportunity in Africa in the years to come.
Excellent, thank you. Another big picture question, if you like, in terms of how does the technological progress and the macroeconomic shifts feature in all of this? For example, the rise of e-commerce, demise of the high street retail, changing work culture, etc.
Great question. I wish I had 3 hours to answer it. There are challenges all over the place driven by technology. Office buildings are probably less secure than they used to be because the ability to work from home or from a Starbucks is clearly there now. Co-working is growing in significance. The traditional office is more challenged than it used to be. The questioner mentions retail, which is an equally good example. Shopping from home, shopping online is of course challenging traditional retail channels. Logistics is a beneficiary though of technological change. There is clearly a need for more and more storage space. So as companies like Amazon sell more and more things online, then you need more and more distribution space. So that market has benefited. And there are sectors of the property market which are resistant to technological change. So fundamental buildings that are of fundamental need to society, whatever happens to technology, and that would include all residential property. People have to live somewhere. It includes hospitals, medical property, educational facilities, what we call social infrastructure. So there are huge chunks of the property market which aren't going to be affected by technology, and chunks that will be affected by technology. And I wish I knew what the impact of driverless cars and delivery vans is going to be on the property market. There's going to be some impact, but I can't tell you precisely what it's going to be at this point.
Do you think that we might face a supply glut of property, especially in the high-end property, luxury residential, grade A office, where the yields are lowest and most sensitive to shifts in the cap rate?
Normally one would expect very low yields to produce high prices and therefore high profits and therefore a lot of development. This time we're not seeing that particularly, with some minor exceptions. There's not a massive development boom going on in office development, with some small exceptions in the City of London and elsewhere, partly because the banks just don't have so much money to lend because of the new solvency requirements, and to some extent a little bit more discipline, which is explained by the near memory of the global financial crisis. So I think there isn't likely to be a huge glut of space. The exception to that is probably in the high-end residential market, where everybody believes they can make money out of residential property development to sell. And it looks like we have a creeping oversupply of 1- and 2-bedroom flats in parts of London, and I'm sure that's true in many other countries. But at the same time, we do have a tremendous shortage of homes. So I'm somewhat sceptical about there being a massive development glut. The conditions aren't in place for that. There's just not enough loose capital around.
Yeah. Do you think that the correlation yield gap will be consistent across markets over the long run?
Yes. We've done this work now in at least 7 markets. So we've looked at the US, the UK, Germany, France, Spain, Netherlands, Australia. We get pretty consistent results. The correlation between the index bond yield, the real yield, and property yields is pretty consistent and strong across all of those markets. So I do think that the basic theory, the basic algebra holds up. And so that connection is my fundamental buying rule for real estate in the long run. It's what I always go back to and what I look at. So yeah, I think it is a long-lasting rule.
Okay, I take that as good advice. Back on the macro picture. Right, so here's a question. Do you have any ideas of what the long-term implications of the new protectionism might be, for example, with Trump coming in and others?
Yes, yes, to some extent. We've lived through a period of 20 to 30 years now where we've had growing cross-border transactions, and the world has benefited to some extent from the ease of taking capital across borders. It's meant that developing countries have been able to raise capital for the construction of badly needed property in cities that need regenerating or even building. So American capital has found its way into the Far East, it's found its way into emerging markets in Central Europe, and to a much lesser extent in Africa and India. Generally speaking, that's a good thing in terms of economic development. Protectionism usually will mean the raising of barriers to cross-border capital, which will inhibit the availability of development capital, which I would regard as a shame, a bad thing. It will no doubt be a message to American investors to stay at home in the US and for British investors to stay at home in the UK for the time being. The euro is the best possible example of this. With the European Union and the single European currency increased the amount of cross-border trade and the amount of cross-border capital transactions, German buyers buying in France, Italy, Spain, and so on. And if you imagine the breakup of the euro, then you would imagine how that would reduce and go backwards. And the same thing will happen with protectionism. The more trade barriers we put in place, then the less cross-border transactions there will be. If you are a property investor and you can buy a property leased to Coca-Cola in Poland, then the risk of being in a foreign market is reduced enormously by the fact that you've leased your building to Coca-Cola. But protectionism means that you'll get less and less international trade, and therefore investors will be more and more sceptical about the risks they're taking. So I think we'd like to see a reduction in cross-border trade.
Thank you. We have another question actually which asks about what type of participants join our real estate program? Is it entrepreneurs and investors or more corporate professionals? So perhaps if I take that one for a moment.
Please. Yeah.
And then if we have any more technical questions, shall we say, then we can revert back in a couple of minutes. So thank you for that, Andrew. That was great. A really whistle-stop tour and ending on some big macro questions which we all wish we knew the answer to at the moment. But we will have some more time to think about those in detail on the Oxford Real Estate Programme. So this is an executive development programme. It's a 4-day programme which we run once a year, and it's really an opportunity to think about all the strategic opportunities, challenges and threats that are facing the real estate and the real estate investment markets at the moment. So you come together with a group of peers from around the world. So we will have about 40 people in the class, and to share ideas with them, with some industry experts and panelists which we'll invite up from London and overseas, and obviously also with Oxford researchers. So we will have the week directed and largely led by Andrew Baum, who's been speaking today, but also we will incorporate Ludovic Philippou, who is a professor of finance at the Saïd Business School and whose work around private equity and investment structures is raising a lot of press and a lot of questions at the moment, so a very good opportunity to learn directly from Ludo. One of the other areas which the Saïd Business School is particularly strong in is the area of major projects and infrastructure. So we will also include Dr. Atif Ansar, who is the Program Director from our MSc in Major Program Management. And we will have an extended case with a gentleman called Yaya Guinaud from the development firm Lipton Rogers, who will really look at what it takes to develop a major project in a major city like London. The program really looks at the challenges and opportunities facing the markets at the moment. You can see the main kind of headlines which we're looking at here, a couple of which we've touched on over the last few minutes. So technology, the way that markets are being disintermediated, fintech and proptech, urbanization, growth of cities around the world, demographics. If we look at a global basis, then there are lots of about 200 countries in the world. 20 of those or so is classed as investable at the moment. But what's going to be the next? Wave of those? And also, with the rising middle class across Africa and parts of Asia, what's the opportunities there? Globalization. So what's going to happen in terms of cross-border investments in the future? So that will be interesting to revisit that in a few months' time, and obviously developments in the capital markets, so what's happening on the finance side. As part of that program, we will ask you to join a small group made up of your peers, so you'll work in teams of 4 or 5 to put together a proposition for a real estate investment fund or a project, and then you'll have the opportunity to pitch that to a number of investors who will give you some feedback on that, which will be valuable in itself, but also a great opportunity to work with people from across the industry to work on a project. And obviously, as well as the academic side, we'll have some industry experts coming up. In short, to answer the question, we have people from corporate real estate firms, we have some investors, so we have family offices, we have some large institutional investors, we have advisors working in the space, and we also have real estate owners who are developing major programs internationally. We will send details of that to everybody who is registered to the webinar today in follow-up, but if you do have any questions, and my details are on the screen there, I'll be very pleased to answer any questions offline. Do you fancy answering with one macro question?
Okay.
Okay. So we have a question here. What do you think if hard Brexit happens? What will be the impact on the UK real estate market in the case of hard Brexit?
Great question. Great question. Unfortunately, I have to answer it with another question, and that is, what will happen to the rest of the EU? We would hope, and I think this is true of most professionals in the UK, we would hope that the EU remains very strong and connected, so that the French elections coming up and the German elections coming up don't create too much of a shockwave, that the euro holds together, the European Union becomes strong and remains strong, in which case the UK probably becomes a slightly less attractive place to invest in the context of a hard Brexit. The forecasts are that we'll end up with reduced economic growth. The dominance of the City of London as a financial centre will probably be challenged to some extent. We will suffer probably a reduction in trade and therefore a reduction in economic growth. So all in all, the UK looks slightly less attractive. Continental Europe would remain attractive as a safe haven in a strong environment. If, on the other hand, the hard Brexit is the first sign of a breakup of the European Union and encourages other nations to vote similarly and creates political turmoil, then the ironic result would be that the UK would look like a safe haven itself, and therefore more money would flow to the UK out of continental Europe. So I think we have to watch very carefully what happens in the elections in Europe this year, and hope that the EU holds together, in which case then the UK just looks slightly less attractive, albeit with a cheaper currency, which will still continue to suck in quite a lot of investors.
Okay, great. Thank you very much, Andrew. We are just about up on time, so I think we'll call it a day there. So really just to say thank you to everybody who's attended throughout this webinar today. I really hope that you found that of value and of interest. If so, then obviously we would like to speak to you about the executive programme in June. If you can also come to Oxford to join us on the 1st of March for the Oxford Real Estate Society Conference, you'll be very welcome to do that as well. We will circulate details of both of those in follow-up to this webinar. So thank you again for attending, and thank you again to Professor Andrew Baum for your time and input this afternoon.
Thank you. Thanks everybody for listening.
Thank you.